Hello and welcome. This is your weekly fix. I'm Smitha Nair. Today, we're looking at the ongoing turmoil in the global financial markets and the implications for India. The collapse of the two banks in the United States, Silicon Valley Bank, SVB, and Signature, followed by the unraveling of one of Switzerland's biggest banks, Credit Suisse, has raised fears of a contagion, wherein a failure in one bank or a group of banks spreads to other banks in the system, or indeed has other macroeconomic implications. Are these just the first dominoes to fall? Is the Indian financial system protected or insulated from these developments? Let's ask Tamal Bandopadhyay, a banking sector expert, a veteran journalist, and author of the recently released book, Roller Coaster An Affair with Banking. Thank you for making the time for speaking to us here at Scroll, Mr. Bandopadhyay.
Thanks, Smitha.
Right. So before I get to the question of whether we as Indians should be worried, etc., could you sort of briefly talk about what is happening in the United States and the Silicon Valley Bank? Would it be correct, sir, to say that the proximate cause of the Silicon Valley Bank collapse was the increase in interest rates because SVB was heavily invested in US Treasury bonds, and as interest rates rose, the value of these bonds fell. If you could, in simple terms, perhaps explain to our viewers this sort of relationship between bond value and interest rates leading to this bank collapse.
Yes, Smitha. Uh, it's the right question, I guess, because there are a lot of misconception about the Silicon Valley Bank, what exactly happened, and at his press conference, U.S. Federal Reserve, Mr. Powell also spoke about it. It says there is no systemic crisis; it's a problem with the particular bank. Now, what is the problem? It's a 40-year-old bank, and it's essentially bank for the um, techies, I mean the tech startups. So they get money from the bank, and they also keep their money with the bank. uh, and this particular bank was flooded with deposits, tons of money, 2021 2022, and this money they invested in US bond, US treasuries. And then what happened is these two things happened simultaneously. Because of interest rate hike in US, uh, the bond yield started rising. And as you know, there's an inverse relationship between bond yield and the value and the price of bond, which means that when the yield rise, the value goes down, which means you are in losses. Now, as long as you don't sell them, the losses become a technical. It's called M to M, mark to market. It's true for all banking system. Even though Reserve Bank of India, you will see Reserve Bank of India's forex reserves came down. I'm talking about a few months back. One of the contributing factors was RBI invested in US bonds, and those bonds actually the value got eroded. To that extent, RBI's foreign exchange reserves went down. So when at the year end, it had to take stock of that. So two things happened simultaneously. The bond value got eroded, and at the same time, had they not been forced to sell the bonds, it would have been fine. What happened to their customers, the techies, the tech startups? They had certain problems in raising money from the investors. So they started knocking at the door of the bank to withdraw their deposits. Now, once you withdraw their deposits, how would the bank generate enough money to support that withdrawal of deposit? They started selling the bonds, and in the process, what was a technical loss actually became actual loss, the real loss. And that's the beginning, and one thing led to another, which is basically a run on the bank. That's what happened here. Even Reserve Bank of India, now, if you look at their balance sheet, the last year I'm talking about RBI balance sheet, one of the contributing factors to RBI's erosion in the foreign exchange reserves, apart from other thing, was the M2M losses, the mark-to-market losses, which Reserve Bank of India had to book because of its investment in US Treasury. Now, imagine a situation: RBI's entire foreign exchange reserve were invested in US Treasury, US bonds. In that case, it would have been a disaster. We don't know. It's a closely guarded secret, the composition of Reserve Bank of India, where the investment, but certainly not the entire reserve. So it's judiciously been done. So in this case, it was not judiciously done. They had tons of money, and the avenue of deploying the money was, I think, there were not too many. They invested in bonds and they had to pay the price for it.
Uh, Therefore, you are saying, is it, am I getting you when you're saying, is this a sort of idiosyncratic problem, which is uniquely a problem with the Silicon Valley Bank? Or
That's
do a number of other banks also have this sort of heavy securities portfolio? The reason I ask you this question, sir, is because one it assumes that typically banks tend to hold a significant portfolio of bonds because they're considered safe assets. And I also assume that the Federal Reserve requires banks to hold them in a certain proportion.
No, absolutely. Say it will vary from bank to bank. Like for instance, even look at India. There, what happened is you get 100 rupee worth of credit. I mean deposits, my money and your money, the public money. Then do the banks invest the entire deposits, your money and my money, in creating loans? No, they do have to keep 4 rupees with Reserve Bank of India in the form of the so-called CRR, cash reserve ratio, and they need to put in some money, I think at right now 18 or 19 rupees, um, in government bonds, even though in theory it's 18 or 19 rupees, but if you see in practically, most of the banks have invested maybe 27, 28, 29 rupees in government bonds. And then the rest of the money, which is close to 70 rupees, they um, invest in loans. And within the loans also, there are different categories of loans. So everywhere in the world, there are the banks do not necessarily put entire money, all their money only for the loans. There is a requirement for investment in government bonds. The requirements could be different for different. The quantum is different in different countries. Like in our case, Reserve Bank of India, and I mean the commercial banks in India, they need to put in money because of our high fiscal deficit. As you know, every year ever since COVID, the government borrowing program is going up and up. And the banks are the primary supporter. There are insurance companies and there are, of course, foreign institutional investors also, but banks are the primary supporters. So US is a very, very different story altogether, because US, unlike India, US, the corporate bond market is very vibrant. So the corporates are not that way dependent on the banking system. There is money from the market, which is not the case in India. So whenever in India, what happened is this: when the bank is investing too much of money in government bonds, then there is a problem. There is scarcity for the corporates. The corporate loan they would not be able to meet. But that's not the case in US. US, there is a vibrant corporate bond market where the corporates raise their money, and the banks put their money also in government bonds, and it varies from bank to bank. So it depends on how much money you invested in bond in percentage term, and also whether you are in dire need to raise the money. In this case, for the Silicon Valley Bank, what happened is this: they have made substantial investment because of lack of credit of tech, and then there's a sudden demand because the techies, the startup tech companies, where they found that the money was, the investment flow was trickling down, so they had to withdraw the deposits. So it happened in the both ways. There were demand for deposit withdrawal, and to meet that demand, they had to sell the bond, and which was at a theoretical level mark-to-market loss, actually became a real loss when you sell it off. And as I said, for the bond, when the yield rises, the actual value of the bond goes down. It's inversely, they work in reverse direction. So that's how it happened. And why did the yield rise? Simple fact: because of US Federal Reserve. The way aggressively for the past 1 year it has raised the interest rates. That's why the yield rose.
Right. About that interest rate hike, Mr. Bandopadhyay, the US Central Bank today has raised its key rate by 0.25 percentage points, despite the turmoil in the financial markets.
Yeah.
Could you, again, for the sake of clarity, explain a few things here? How does increasing interest rate help in fighting inflation? Why, despite this, as you said, aggressive sort of series of interest rate hikes in recent memory by the US Central Bank, which is nearly 5 percentage points in over less than a year, has inflation not come under control? And how does the Fed weigh the risks, Mr. Bandopadhyay, of raising interest rates, which could, potentially have this bringing bond value down versus the need to tame inflation?
Before that, just Smita, one context. If you see historically, for the past 50 years, whenever there's a series of interest rate hike, it has led to financial sector crisis in US. That's given. I'm not cooking up the story. There are charts to show that. Now this time, what happened is this inflation went haywire. I mean, post COVID, there was now it started with supply side disconnects, and then everything else added to it. Russia Ukraine war, oil price, everything globally. I mean, there is not a single country where you'll find that there are certain countries where inflation is up 100%. India is relatively better off. Our in our case, our inflation flexible interest inflation target is 4% plus minus 2 percentage point, which is 6% is the upper end. And the past 2 months we have gone beyond 6%. That's a separate story. Now, ES has been continuously fighting, as you rightly said. It's 25 basis point hike, 4.75 to 5. Now, will it? And before that, ECB also hiked the rate. And as we speak, next 24 hours, I think Bank of England it's meeting, and there is a possibility of rate hike again. And here the inflation is much more severe than the rest of the world. Just now, I was going through a University of Massachusetts study which talks about now the US corporate guys are their profit is rising. Anything, their prices are rising and their margins are rising. And it's not it's not, there's no wage cost rise at all. This is something happened, that kind of the way their profitability and their margin has been rising, prices have been rising. Last was seen post World War II. Now, that is as we speak, University of Massachusetts, that's the studies talks about. So there are multiple reasons of inflation, and historically, I mean, it's a classical way of fighting it out, inflation, because you make money more expensive so that you spend less. That's the why does central banks across the globe fight inflation the same way? It's a classical theory. Is this: you make money more expensive, and then you rein in our demand for things, our ability to spend more money, and that's the reason. Now, is U.S. Federal Reserve through really scared of what happened in first the Silicon Valley Bank and then the Signature Bank? Will it go slow? It doesn't seem so. There is at least one more hike, it looks like, but there's a subtle change in Powell's language, if you have seen that. Earlier, it was just like open-ended; it could go on and on. But this time, if you see his press conferences, language is slightly different. I would like to believe there will be one more rate hike of 25 bips in the next FOMC meeting, and probably that would be the terminal rate. So 4.75 right now to 5 to 5.25. Earlier, people are talking about 5.5% and 6%. Probably will not go that way.
Okay. Mr. Bandopadhyay, one has also been hearing this term in the context of these bank collapses called contagion. Can you paint us a hypothetical scenario, sir, to explain how or in what circumstances could this potentially result in a contagion that has an impact beyond American shores? And then the fact of the matter: do Indians, as things stand today, need to worry about how safe their money in the banks is, or what the potential sort of fallout of what is happening in the US and Europe have on Indian shores?
Sure. If you go back to Powell's press conference, he ruled out any sort of systemic crisis. He said it's a unique case, a governance issue, etc., etc. So my understanding is this: yes, there's a problem in US because first we say Silicon Valley, and then after that we say the Signature Bank. There are two banks failure. Now Silicon Valley was 40-year-old, Signature Valley was 24-year-old bank. Now, but they are two unique animals. If you see, while Silicon Valley Bank was primarily for the techies, the Signature Bank was actually for law firms and real estate firms, etc. And again, how did it fail? Why did it fail? Was there mispricing of risk? Was there asset liability mismatches? No. Actually, they allowed cryptocurrencies, as an asset to be kept with the bank. And then when is that FTX cryptocurrency exchange failed, that led to the failure of this particular bank. So these two are unique cases. Credit Suisse, again, it's a very unique animal. You know, it's much older than these two banks, and there's a cocktail of scandals in Credit Suisse. You know, I mean, what happened is this: last year there was a 2.1 million fine by the regulator because of cocaine cash laundering. That's happened in Credit Suisse. Then it was followed by the biggest loss ever since 2008. And then we saw massive layoff, etc. Now, one particular entity, one of the investors, Saudi National Bank, it wanted to invest a lot of money there, but there is some regulatory restrictions. It could not invest even though it wanted to. And then there are a lot of other issues were there. There are a lot of scandals. Top management got changed. Then a lot of people were asked to go. And then what happened is this January 2022, the chairman resigned. There is some because of violations of some COVID protocol. He was there hardly at the helm for 8 months. After that, the new CEO came, but the July last year, his policy for changing the bank strategy, etc., did not get the approval of the investors and all. So this was something, a time bomb ticking away, and all three banks, whether it's Credit Suisse or Silicon Valley or Signature Bank, they are all unique in their characters, very different kind of beasts, and they have their own problems. But because it's happening together, we are talking about systemic crisis and contagion. Now, will it spill over to India? I think it's a hugely exaggerated fear, hugely exaggerated fear, because the character of our animals are very different. We had a similar kind of cases, different asset liability mismatches, or say overexposure to stock market, like say Global Trust Bank happened early this century. The exposure to stock market has killed it. That's one example. Or the governance issues, what will happen in the Yes Bank case. These are the different issues. But as of now, as we speak, if you look at the Indian banking system, if you look at the last 4 quarters, every quarter the earnings of Indian banking system is better than the preceding quarter, because their net interest income is going up and up, because there's a huge credit uptake, which is something a decadal high. At one point of time, it was closely 20%. As we speak, probably 16 odd percent is the credit uptake. So they are earning their interest pretty well. Now, at the same time, there are a problem with the deposits. I'm coming to that later. Deposit is not been keeping pace with the credit uptake. That I'm coming to that later. But the fact is this: interest banks are earning well in terms of interest rates, interest income, that the so-called NII, net interest income, which is the cost between what you earn from your giving loans, and what you spend on your deposits. That's high. Second is there have been recovery. As you know, our banking system in the mid last decade was saddled with a lot of bad loans. I think our gross bad loan was some 11%, or more than 10 trillion, 11 trillion plus, which was the second highest among the G20 nations after Russia. Now, Reserve Bank of India took care of it, the so-called asset quality review, which was led by Dr. Raghuram Rajan and carried forward by his predecessor Urjit Patel. It happened. It cleaned up the bank's books. So then what happened is, and also by 2016, in a record time, we have the IBC, the insolvency code in place. Now, armed with IBC itself has been helping the banks to recover money, and also indirectly IBC is helping bank because the threat of IBC. Now, corporates are now, scared of losing their shirt, losing their empire. So they're coming to the discussion table. Earlier, they were running away. They're coming back to the discussion table. So banks are recovering money through IBC and outside IBC. So second contributing factor of the bank's profitability is that high recovery. And third, because of high recovery and high interest income, banks also have been able to set aside money and to create the so-called provision coverage ratio, which means essentially the taking care of their bad money. Once you make the adequate provision coverage ratio, as I speak, out of 12 public sector banks, I think 8 has provision coverage ratio between 80% and 90%, which means 100 rupee worth of loan has gone bad, out of which 80 or 90 rupees you have already kept aside. So what does it mean? Now, anything you earn, you recover more than 10 or 20 rupees, you actually adds to your profitability. So higher recovery and higher interest rate income is leading to banks profitability, and then they are all well capitalized, and their PCR and the provision coverage issue is pretty high. So their balance sheets are pretty strong and resilient. At this
Hmm.
point of time, I don't think there is much to be worried about. Having said that, if you are not asking me the question, but I am just carrying it forward, there
Right.
are there are certain level of incipient stress. A little bird tells me that certain banks are seeing it. Now, particularly, and the villain, the culprit is the rise in interest rates. You know, you see, our interest rate have not gone up to that extent. From US, from zero to has gone up to 5%. But in India, between May and now, as we speak, and of course, it's 15 days away. We are from the next RBI policy, or less than 15 days away. Uh, it's gone from 4.5 to 6%, right? Four, no, sorry, 4% to 6.5%.
Percent.
4% to 6.5%, 250 percentage point. Now you see the bank loans are typically a set of bank loans, about 40% odd or little more than that, are linked to something called external benchmark. What is the external benchmark? That's the RBI's policy rate repo rate or the 364-day treasury bill rate, which means about at least 40% of the bank loans have the cost of for the borrowers have gone up by 2.5 percentage point in the past 1 year, right? That's what is
Right.
happening. And the rest of the bank loans are linked to MCLR, that's the marginal cost based loan. As the
Hmm.
banks raise their deposit rates, they are also going up. So average by 2 percentage point and 3 percentage point rates have gone up. Now, can everybody stomach this hike? Particularly the unsecured loan, MSMEs, home loans and auto loans, the vast retail loan segment. I think there would be some stress. My understanding is this, the incipient stress is already showing. Now, what does it mean? Technically, a loan goes bad if I am a borrower, I am not, and you are a banker, I am not able to pay or service my loan, either interest or principal, for more than 90 days. Then only
Right.
it become an NPA. But there are stages in which it goes to that, no? Through which it goes to that. So,
Hmm.
for instance, if I'm not able to pay for the first 30 days, it's called SMA 0, that's special mention account 0, SMA. 30 to 60 days, SMA 1, that's special mention account SMA 1. And 60 to 90 days, SMA 2, special mention account SMA 2. After that, it becomes NPA. So NPAs have not been created so far, but my understanding is this: there are certain loans, it is there, it will be few basis point depending on the banks, SMA 0, SMA 1, and SMA 2, which means in the coming quarters, if the rate hike continues, there would be certain cracks, and the banks will have to show their NPAs. There is no place to hide anymore.
Okay. Thanks for that clarity on that point, Mr. Bandopadhyay. To close, just to pick up from what you said, particularly about home loans, the big headline the last week was that because of the sort of subsequent or continuous increase in repo rates, we have seen the loan tenures, which is for the benefit of our viewers. Basically, it means that if you take a home loan, how much time will you take to pay that back? Your loan tenure. In some cases, it has gone up to 50 years. So, for example, if you're taken a home loan in your 30s, you could potentially be repaying that loan into your 80s. Could you sort of explain, particularly in relation to home loan tenures and the increase that it has seen, and what's the sort of outlook going forward?
No, say outlook all depends on Reserve Bank of India's policy. I mean, whether RBI will stop here, or whether RBI go for another 25 basis point, and that will be the terminal rate. That's 6.75. We need to wait and watch. So that's wide open. ECB has already raised hike its rate. US Federal Reserve at hike its rate, and I would like to believe that Bank of England also will go for a hike. Now, can Reserve Bank of India afford to not to do this, or RBI will do this? Because our inflation again at continuously for 10 months it was higher than the upper band of the inflation target, and because of that Reserve Bank of India had to actually give an explanation to Parliament why it happened. It's a closely guarded secret, even no RTI could find out. They refused to part with the information. We are very interested to do what is RBI's, how does RBI want to maintain, I mean, what kind of commitment it's given to keep it within 6% in future. And if you see, the Reserve Bank of India is not saying, at least till the last policy, that it will be cool within 4%. It talks about pretty high, less than 6%, but not in 4%. So will RBI stop here, or will RBI go for 25 basis point? That's a separate debate altogether. It depends on that. Meanwhile, home loan rate was the lowest ever, if I'm not mistaken, before the rate cycle started. There are some banks who are given at 6.25 even home loan. Now, what happened from 6.25, if your loan rate becomes, say, 250 basis point more, which means 8.75. So certainly you can see the percentage of how much it will go up. Now, depending on your capability and whether you are a businessman or you are a daily wage earner or you are a salaried class, so on and so forth, it depends on whether you can service the higher loan or you don't service the higher loan. You continue to pay the same EMI, that's the equated monthly installment, but then your portion, your maturity profile goes up. 10-year loan can become 15 years or 20 years. Essentially what happens is this: if you and I take home loan, at the initial stage, for every 100 rupee I pay towards the EMI, probably 90 rupees goes for interest and 10 rupees for principal. And as we proceed, it goes down. And towards the end of 10 years or 15 years or 20 years, that happens, we are servicing more the principal and less interest. Towards the end, very minor interest, only principal. But if because of the interest hike in interest rate and I choose to lengthen my maturity profile, then what will happen? I'll keep on giving the interest, not the principal. I'll not be able to principal. And I doubt whether actually banks will allow anybody to have, theoretically it's possible 50 years, but where is the cash flow for me for 50 years? Even if I take money in my early 20s, typically the age of retirement is 60, 65. If you're a bank chairman, 70. but then how would anybody can give 50 years maturity? So it's not. So it depends as it pans out. But again, as you said, that then don't get scared. It's a rate hike cycle. But all even in US, people are talking about next year we'll see rate cut. So even India also, as we find the rate cut, then again it will even out. So we need to see how the cycle moves. Let's not scream and get scared that it becomes 50 years, because it's not that interest rate here, wherever we are, it's going to stay. Few months down the line, or if a year down the line, the cycle may change and we may see the interest is going down. That's true everywhere. Like US, people have started talking about, earlier they talk about in this calendar year itself we'll see the reversal, but now they are talking about no, probably it will take time, but US Federal Reserve will reverse the cycle. In same is the case with India. We'll see if the growth is affected, too much of rate tightening, then the RBI will have no choice but to. Of course, there are multiple things to take care of. One is inflation. Other is, of course, RBI will not officially accept it, but the currency. What is the level of currency? Again, if our interest rate differential is too much with the rest of the market, rest of the world, then our currency will be under attack. So one of the reasons we need to raise interest rate also to protect the currency, which Reserve Bank of India will never say officially. Their official stance is this: we always want very smoothening thing. We don't want any kind of disruption. We don't care about the level of currency. That's the official stance. But heart on, hand on heart, in
Right.
private, people will say no, we do care for currency, and that's also one of the contributing factors when the rates will rise. So in sum, nothing to be scared of at this point of time. I think we will actually sort of exerting the entire fear now, because the rate hiking cycle is not here to stay,
Hmm.
and it will change. Once it change again, the things will change.
Hmm.
I mean, the interest rate will go down, so it will even out. We need to wait and watch, but at this point of time, yes. For the record, even though typically home loan tenure is 20 years, but you ask any bankers on the bank's book, average home loan tenure is 6 years. Why? You and me, often we pay off, but still is there like gold. When you mortgage gold, you the first priority in India even now is just get back the gold first thing.
Right.
You generate money and you get back, even though you were taking 2 years loan, but maybe 6 months or 8 months time, you take the gold back to your locker. You don't
Hmm.
want to part with your gold. Similarly, for home loan, all of us, the employed class, the salaried class, we want to pay off fast so that loan free thing and all. So the average maturity is 6 years, because people do service the loan faster. Whenever they get extra money, they do. And also they shop in a sense, from bank A they go to bank B or bank C, looking for lower interest rates. So there's arbitraging always happens. So in the bank's books, typically, even though it's 20 years, it's actually 6 year maturity profile for assets. So I think this 50 years theoretically is correct. And yes, theoretically we'll keep on paying the only the interest, not the will not be able to touch the principal. But this based on the presumption that interest rate will continue to remain high, 6.5 or even more. But Smitha, and we know that the cycle will change. Again, it will come down and things will even out. So let's not overreact to this. I don't know whether I'm able to answer your question.
Right. No, no, you did. You did. You certainly did. I'm tempted, sir, to close this discussion, since you were banking editor for so many years, to ask you if you had the main copy in your broadsheet today on what is happening in the US and its implications for India. What would you suggest that the headline of the copy be?
No, I guess RBI will be bit, not a headline, but the gist of it. I think the learning from this the what's happening in US and
Hmm.
this kind of banking crisis. This RBI would need to be cautious, both in action as well as the language. That's one part of it. And the banks also need to be cautious, because the mispricing of risk, as I said, it between you and me, it has happened in Indian bank also, not in government bonds, because in our case the government bond is primarily range bound. You will see, like for instance, this March quarter end, there will be minimal M2M losses. RBI manages it well. But the mispricing of risk happened, that all the banks rush to this retail unsecured loans, and that's a kind of, I'm sorry to say, is this sort of hard mentality. In a decade back, all the banks were going to infrastructure loans and corporate loans, even though you don't have the ability to appraise the risk. The it depending on the profile of the bank and the size of the bank, your risk management and underwriting capability. Now, State Bank of India can afford to go where it could, but does that mean other banks also can? State Bank of India is one of the top 50 banks in the world, and it's roughly 22-23% of the Indian banking system. But what was happening a decade back, any credit appraisal for corporate loan, large corporate loan, or infrastructure loan, typically SBI caps, the merchant banking arm of State Bank of India, will do the appraisal. Then a State Bank of India will take the first exposure, and then all the banks will make a beeline, irrespective of their size, their status, their scale, and they will do that. But then when the hit comes, State Bank of India can absorb it, but not the others. The similar thing happened in the past few years, post COVID, when it comes to the retail loans and mortgage loans, etc. MSME, you are sort of, even though you are not willing to, but there's a government wants it, and the ecosystem is as such. There are a lot of incentives also, so you go to MSME. But for home loan and auto loan and unsecured loans, banks blindly followed like one bank is doing, so bank B and bank C and bank D also followed. Again, the mispricing of risk without putting in place the right kind of infrastructure, risk management, and underwriting capability. So that, I think, a big lesson from this uh, so-called contagion is this. I think the banks need to be careful. They need to do some sort of soul searching, that will they continue to do this, or will they be cautious? I would like to believe it's a lesson for both the central bank, about, yes, we need to manage inflation, but to what extent we can go stretch
Hmm.
ourselves when it comes to rate hike, and for
Hmm.
the banks, to what extent they go the chase the assets. I think both for the
Right.
regulator and the regulated entities. That's the lesson. Having said that, there is no immediate scare, there is no immediate fear of contagion affecting Indian banking system. We are resilient, we are strong, we are well capitalized. We can manage it.
Okay. All right, Mr. Bandopadhyay, thank you, sir, on that note, for your insight into this ongoing global financial turmoil and the potential implications for India. Thank you.
Thanks. Well, Smita, can I leave now?
Yes, sir.